Have you ever wanted to invest in the stock market, but don't even really know what the stock market is or how it works? Well, if that's you, you're in the right spot. Today I'm going to teach you exactly what the stock market is and why any company would even want to go public. Stick around. What's going on, guys? I'm Jesse Pena, and this is Knowledge is Sexy, the channel where I focus on making you a little bit sexier each and every week by teaching you something new and interesting. And let's face it, guys, being interesting is attractive. So this week I'll be teaching you what the stock market is and why a company would even want to go. Well, before we jump into this, let me give you a little history lesson. So back in the 1600s, there were these merchants that wanted to start these huge companies. Well, they couldn't fund these huge companies. It required way too much capital. They couldn't do it on their own. So as a result, several investors would get together and put their money together and really be able to grow this big company. You know, the more money, obviously, the more you can do, the bigger you can be. So that business model was started. It was actually, they were forming these joint stock companies, and it was a game changer. It was changing the way business was being done. Multiple investors were able to come together and just really dominate their respective markets. Well, in 1602, this company called the Dutch East India Company sold their first paper stock, or the first paper stock ever. And by selling a paper stock, it made it so much easier for these investors or shareholders to buy and sell and trade stock. That was the real game changer right there. That was pretty much the first stock market, able to go and buy and sell and trade your stock or your ownership in that company. That business model migrated its way to all these other countries, and it eventually landed in London. And it was about 1773, somewhere in there, 1770, 1773, somewhere in there. All these stock traders out in London, it just got so crazy, right? It just, those shares being sold and traded everywhere. They needed some kind of organization. So they decided, let's meet up at this coffee shop, and they would just meet there, and they call it the marketplace. They were organizing all this. So they had an organized place where they can go and do their trades and their stuff like their exchanges. Actually ended up taking over that coffee shop and changing the name to the stock exchange. So that was the world's first stock exchange, the London Stock Exchange. Didn't make its way to America until 1790 or so. And many, many years later, we're here and it's still thriving. It goes up and down on a daily basis. It makes people millionaires and it breaks people probably on a daily basis. It's just crazy how far it's came since the 1600s. And now you get to learn a little bit about it. So hope that's something interesting to you. Hope you learned something there. It might be pointless, but it's just cool to know. All right, well, now you know the history. Let me teach you a little bit about the stock market and what it actually is. So for the sake of learning, we're going to call these pies, okay? These are going to represent companies, but we're going to call them different types of pies. Now, in the stock market, there's thousands and thousands of companies out there. We're going to use three companies, or three pies, and you can call it, we'll call it the pie/stock market, because I'm going to refer to them as companies and pies probably several times. But I'm going to try to make this as clear as possible, and I think this is a great example. So let's start off here with apple pie. Now, apple pie is a very traditional, probably one of the most traditional pies out there. And it's really safe to say that majority of people like apple pie. Now, say apple pie or this company here wants to grow or launch on the market. All three of these companies they want to launch on the market. Now, let's say this company wants to. Now, why would they? Well, they want to launch on the market because they want to raise money to grow, okay? So what they're going to do is they're going to divide their company into different slices here. So boom, now they got all these different slices of their company, and what they'll do is, in order to raise money, they're going to sell slices or shares of their company or their pie to investors, okay? So say you want to buy a slice of apple pie. So as an investor, an apple pie or a company that is more traditional is a lot safer of an investment, okay? It might not yield you a huge return, but I'll get into that in a minute, okay? But it's a lot safer investment here, okay? So, that being said, let's say they can sell a slice of apple pie for $2. A slice or a share, okay? I'm gonna call it a slice, $2, $2 a slice, $2 a share. Because it's a safe investment. People are most likely going to like their pie. You can't really mess that up. Now, here we got avocado pie. They're in the same boat. They want to raise money. They want to grow. They have this great business, but they want to grow it. Well, you think of avocado pie. I mean, I've never tried it. I could kind of see how some people might like it if they kind of make it like a cheesecake or something and it has like a taste of avocado or something. I'm not sure. But I can see where it could be great or it could be horrible. But I can definitely see that there's some potential there, right? So this company wants to raise some capital as well. So they break their company up into slices. Now, since it's a little bit riskier, it's not apple pie that everybody loves. It's avocado pie. Some people might love it, some people might hate it. But you never know. So it's a little riskier as an investor or as a consumer trying to buy some. So you're probably not going to pay as much as you're going to pay for apple pie, right? So let's say that they're able to get $1 a share or $1 a slice because it's riskier. It's not as good. It's not guaranteed that that's going to be amazing. No, neither is this, but it's a lot better chance that apple pie is going to be good, right? So avocado pie is a little bit riskier. They're going to be able to sell or sell their slices or their shares for about $1 a share. Now these are just numbers for reference here, guys. That's not how every share is set up. Now moving on. So onion pie. The hell is onion pie? I mean, I like onions, but onion pie, that just doesn't sound good. So that being said, it doesn't sound good, right? Do you think anybody's gonna want onion pie? Probably not. I don't think anybody in this world would want a pie made of onions. But it's a company and they want to sell shares, they want to grow. So you think they're going to pay $1 or $2 or be able to sell $1 or $2 slices or shares? Hell no. They're probably going to get, let's say, 10 cents a share because that is like a no-brainer. I don't think anybody's going to buy onion pie. So that's basically how this works. It's a supply and demand thing. So you got people who are going to most likely be interested in apple pie. The demand for it is going to be a lot higher. So the supply, they're going to charge more for it. Onion pie, probably nobody likes it. Nobody's going to want it. So you're not going to be able to sell it for as much, right? Now, let's say that Martha Stewart has this show and she goes out and says, damn, this onion pie is amazing. It tastes amazing. It's the best thing ever, blah, blah, blah. So all of a sudden, all these other companies and newspapers or news channels start making videos. Oh, this onion pie is amazing. And it just starts blowing up. Well, say it blows up and 6 months later, they're selling more than ever. And it's just this national phenomenon, right? Well, especially it's trending, right? Everything trends nowadays, so it's trending. Onion pie, they're just selling a hell of a lot of slices. Well, you think you're gonna still be able to buy it for 10 cents? Because when they first launched, nobody wanted this shit. Well, now everybody wants it. Hell no, they're gonna start charging. Let's say now they can charge $5 a slice because they're popping. Everybody's buying that stuff. So now their value went up, their market value went up, so they're able to charge more. So say you would have bought this when they first launched at 10 cents a share. How the hell do you do this? 10 cents a share. Okay. If you would have bought this at 10 cents a share when they launched, and all of a sudden they blew up, and now they're selling for $5 a share, that would be called a great investment. You would have made a whole bunch of money. You would have made $4.90 per share, right? Because you took a risk. The chances of you winning were really slim, but that risk, high reward, boom, you made all this money because that shit blew up. So the same thing works in reverse. Say apple pie, you made the safe investment and you bought a $2 slice of apple pie, thinking, okay, this is a safe investment. They could make some money. They could grow a little bit, blah, blah, blah. Well, then the study comes out saying apple pie, or instead of a study, let's say that the CEO of this company sleeps with his assistant, right? He has an affair with his assistant. It goes viral. It hits the news. Everybody starts freaking out. This company is going under. All the investors, all the shares for this company, everybody's probably going to start dropping shares. They're going to start selling all the shares. This company's going under. Everybody's like, okay, this company's going to go under. They're all over the news. So you think that they're still going to be able to sell for $2 a share when their CEO's on trial? Probably not. So this is actually going to drop down to 50 cents. 50 cent. 50 cents a share. So you just lost. If you would have bought this, taken the safe investment route, bought it at $2 a share, and then the CEO goes and has an affair, boom, you just lost. You just made a safe investment, but there's still a risk there. You just lost money. You just lost $1.50 per share. Now, that is almost exactly how the stock market works. It's so many things influence the stock market. There's change in leadership, the press, so that's bad press. He sleeps with his assistant. Good press or bad press. Say the good press was right here on the onion pie. There's so much things. There's trade stuff. Like say they're buying their material or their ingredients from another country. Well, there's these trade wars that start going on, and now we're taxing U.S. or wherever you live. Your country's taxing everything that's coming in from this other country, like ×3 or whatever. The stock's going to go down because the margins on that company are going to go down. So there's so many things that play a variable in the stock market and the prices of the stock or the share of each company. But I think that this is a very simple way to understand what the stock market is and why a company would even want to go public and sell parts of themselves. So recap, these companies they want to grow. They want to take their company to the next level. They'll make themselves public. They'll sell parts of themselves or shares in order to raise capital to grow and do that. Now, you as an investor, you go and you do your research and you say, okay, this is a good chance that this company is going to grow. Boom, you invest your money and say it grows, you're going to make money and you're going to be happy. You're going to be able to make profit, right? But it could be risky like this apple pie and you could lose money. So it's high risk, high reward. It just a whole bunch of variables there, guys. All right, well, I hope you learned something from this. Do me a huge favor, though. Don't go and start trading stocks without doing your own research first. Remember, the goal of my channel is not to make you an expert stock trader or anything that I teach. I don't want to make you an expert in that. My goal is to teach you a little bit of new information on a weekly basis because I truly believe that knowledge is sexy. I believe that the more you know, the more interesting you are, the better you can communicate with people, the more you have to talk about, and you're constantly interacting with people. It's way easier to build relationships when you can talk about something that you're both interested in. Now, with that being said, make sure you comment down below something that you might want to learn, and I'll make sure to put that on the list for the next video. Like this video, please. If you did learn something, subscribe. Turn the notification bell on. It'll let you know each time I post a video. I'm posting one time a week right now, and I look forward to posting more. Thank you so much for the support, guys, and I'll see you in the next one.